is currently 50,000. What is that? What is that going in cap rate, basically, in the current condition that you'd be getting? Ooh, I see Lou got the NOI. We got our first answer on the board. Let's see if everyone, if you have an answer for the current in-place net operating income, go ahead and punch it into the question box. Lou, you are correct. Guy, you are correct. Nice. Amy, correct. Mark, you're off. Dan and Sue, you're correct. All right. Got a few. Robert, Ty, we gotta rework those numbers. Stephen, Tammy, good job. Marlene, you got to take out the operating expense to get to your NOI. All right, answer. Well, let's go. Let me go now to the next. Let me go to the answers of the as-is in-place numbers. Okay, so good job, everybody. Great work. Again, this is a safe place. We want to practice and get to our numbers here, right, so that we get comfortable and knowledgeable so we can do this on many deals. So in our, kind of our basis situation is we know from the knowledge we already got shared that the current market rents are below the market. The current rents are below the market. Excuse me. So we have this 20-unit apartment building at $800,000 they want for sale price. So what the formula to get to our NOI here on the as-is numbers is 20 units times 70%. So there's actually 14 units being leased, being rented, I should say, at $750. So $750 times, that's our monthly growth, that's our monthly actual income. So 14 times 750 is 10,500. Now you need to multiply that times 12 months to get our annual income in place, and we're at 126,000. Now, I'm getting a few questions. I thought you wanted to factor in vacancy. We'll realize with the as-is numbers, when we're going only off 14 units, we already know the vacancy, right? So we don't have to take it out again, because at 14 units, we're at the actual vacancy. So that gets us to our gross operating income of $126,000. Now, in this case, the expenses that we were given, oh, that's funny. Oh, yeah. The expenses that were given, I should correct that, actually. Oops, sorry. Let me correct that. Just got two numbers here. Is $50,000 in this as-is scenario. Just correct that right here for you. And what we have is this NOI of 76,000. So if you got to 76,000 of NOI, you're correct. So good job. All right. So the value of this property, if we bought it at 800,000, we'd be buying it at a 9.5 cap. So I'm just curious how many people would buy this deal? How many people would buy this deal? Any takers? How many people would buy this deal? And why would you buy this deal? Well, gosh, 9.5% is pretty good, right? But primarily, there's opportunity. Where is the opportunity, right? What factors have we not calculated yet on the opportunity? Well, we have rent opportunity, market rent, and we have vacancy opportunity. And now what I want everybody to do is I want you to do this one more time. But now I want you to do it off of the potential rental income. Okay? The potential rental income. And I want you to do potential rental income times the current potential rents, which is market rents. So potential rental, the 20 units. So do the 20 units, do the vacancy, market vacancy, do the market rents. And then what I want you to apply is 50% of expenses. All right? So I'm going to give you the percentage I want you to apply, and then I want you to do 50% of expenses. Now, when you get there, tell me your NOI of the potential deal. If we were at 5% vacancy, if we were at the 800? Oh. What did I say to, 900. I gotta fix the number here. I was doing off a different number, I think. All right, I see the answers coming in. So if you got 216 as your gross, 205. Yeah, 102,600. So we have 102,600. So again, I see everybody getting that. So GOI is 205. NOI, I see everyone dialing that in. So again, how we got there was, and one of the tricky things here is, where do you get your vacancy number from? Well, the vacancy number should come actually off your gross operating income, which is that 205,000. So the 102,600 is your NOI. Okay. Now I want you to do one more thing here. So I see everybody's dialed in pretty well on that. Again, to reiterate, we did 20 units times 900, right? So if you did 20 units times 900, you're going to get your potential gross rental income. And then times it by 12, don't forget that part. So we're starting with this 216,000 of income. And then your 5%, take 5% of that, which is 10,800. That's your vacancy rate, so take that out. So 216 minus 10,800. And then what we said, that gets us to 205,200, and then we said 50% are expenses. So just, you can multiply it by 50%, or you can just divide it in half, right? And that gets us to our 102,600. Now, one more question. If you do 102,600 divided by the market cap rate of multifamilies, which is 8%, what will you be selling this property at if you actually get it to market rents of 900, to market vacancy of 5%? What would you be selling it at? Right? Remember, you take the NOI divided by the market cap rate that deals are trading at, and the answer is 1.2 million. So 1,282,500. Now you should be able to do this math in your head. Let's just assume there were capital improvements of 100,000, and this was over a 2-year period. And what's 1.2 million? We'll just round it. What's 1.2 million minus 900,000? Because we bought it for 800. We did capital improvements of 100. What's that? 1.2 million minus 900,000, 300K. And folks, that's the goal, right? The goal is to have this arbitrage, and along the way we're collecting rent checks, but to buy a property, in-place income, pull on the lever of rents, vacancy, operational efficiency, and then at some point you can either refinance and keep that property and pull out your profit, tax deferred, really tax free in the moment, or you can go to market and sell that property and collect your profit, do what you want with it, right? Really good job, everybody. That's good stuff. I really wanted to focus you on high-level stuff and seeing and finding the opportunities, and then and practicing it tonight, because this is the back-of-the-envelope analysis. You should be able to do this all within really 15 to 5 minutes of someone presenting a deal to you. Or if you're looking at LoopNet, literally, if you're getting pitched a deal, you could do this in 2 to 3 minutes. That's the goal, right? And again, in this example deal, you forced appreciation over a period of time to get to market rents and market vacancy and made a $300,000 gain. Let's call that over 2 years. It's a good place to be. But you have to be able to identify opportunity in the beginning to put yourself in that position. So, good job, everybody. Give yourselves a pat on the back. And now I want to finish with the real life case study. How many people were on last month's training with Chris and I going over the office deal that we're currently tracking, reviewing, and we're in process of analyzing? How many people were on last month? Good. A lot of you. How many would like an update from last month to this month on where that deal went, where it is, and how we're looking? All right, Chris, are you alive? I know you're multitasking as usual, looking at deals, crunching numbers. Are you there?
I'm here, Paul. I'm here. I'm asleep, and I'm riveted by your delivery. I'm learning things from you all the time.
Chris, I love it. Thanks for putting us on. There's a lot of team members were on last month. A handful were not. So if you don't mind, and although we've been working on it, if you can give them a quick recap of the deal quickly for those folks that were not on, and then really update the work, the meetings, the deal analysis, and literally based on kind of what we've been going through, tie it all in on an explanation of if this deal is still off tracking, which obviously I know the answer because we're working on it together. But why don't you give us a quick lead in on the deal, and I'll bring up some numbers here, and then where we're at today.
Absolutely. Hello, everyone. So this project is one that we're working on in real time.
Chris, because there's new people, I always like for people to hear the background of the awesome trainers and team members that allocate their time. Give a quick resume, your experience, your development team, just a quick resume, because people need to understand your qualifications and how good you are at what you do.
Yeah, absolutely. No, I'd be happy to. So I've been in the business for 20 years and predominantly doing ground-up development of retail shopping centers. So we do everything from your typical neighborhood shopping center with a grocery or a pharmacy and a few shop buildings around it, to what we call a major power center. For example, one that we did in the Central Valley of California is over 1 million square feet, and that was Costco, Target, Best Buy, Home Depot. Name all of the big box and retailers that you're familiar with. They're there. So we've done projects small and big, and predominantly our history has been to do ground-up development. In 2009 and 10, with the downturn in the economy, there was blood in the streets, as everybody knows, and we looked at what we do as ground-up developers, and we said, let's take these lemons and turn them into lemonade. We're taking all of the skills that we have as a development company, and we're going to reorient that towards buying distressed assets. So we began to look at projects that were broken for some reason or another. That might be a building that is in a genuinely good environment, has good fundamentals. The building is, there's no structural obsolescence. There's no marketing deficiencies. You just maybe have a landlord who was over leveraged and is going to lose the project to the bank. You may have actual development projects that were stopped midstream, again, because of the lending environment or because of some key anchor tenant pulling out of the deal at an inopportune time. You all remember that some really smart people lost a lot of money, and genuinely good developers were exiting the space and getting burned left and right. And we have excellent financial partners. We have excellent financial relationships. And we were in a very good position to have quite a bit of cash to go out and spend and buy selectively where we saw excellent opportunity. So we did that, and the beautiful thing about this transition where we saw great opportunity to pivot, if you will. A typical ground-up development project will take 5 to 7 years, but when we flipped that switch and became investors, we were buying projects that were generally completed or next to completion, and we could take a 5 to 7 year time frame from start to finish, and we could condense that down to, say, 2 years, meaning we're buying a building that already exists, we're fixing whatever problem created the opportunity in the first place, we're bringing it to a stabilized value, and then we'll turn around and sell it in the marketplace. So that general model is pretty much more of what we follow now. We still do ground-up development deals. We do retail. We do office. We've done multifamily residential renovations. We've done everything in between. We've done self-storage. You name it, we've done it, and we've learned a lot of skills along the way. But generally speaking, what we try to focus on now are simple deals, which is buy low, fix the problem, sell high. That's it in a nutshell, Paul. I could make it longer if I wanted to, but that's about what we do. And we've got a long history of doing this. I would say that at this moment in time, we probably have 30 different projects going. And again, these are ranging in value from a small retail rehab of $1 million to $1.5 million up to projects that are well over $50 million in value.
Awesome. No, just thanks. I always want to make sure people know background and track record. And I mean, Chris is one of the smartest guys I know, and more importantly, him and his team execute at a very high level on the deals that they do. That's why we do so many transactions with them and jump at the chance to participate and work alongside them when the opportunity arises. So, and I'm just, I'll come back to this too after, because I saw a few people ask for this potential slide, but I'll come back to it after we do an update here. So Chris, this deal is an office building in your neck of the woods, literally next to where your office sits. If for those folks that don't know, tell them where you work and live.
In the right photo that you see in the slide, that is a photo of beautiful Pebble Beach, the Monterey Peninsula, which is where I've lived, sparing a decade when I went to college and lived in San Francisco. I've pretty much lived on the Monterey Peninsula for the majority of my life, and I'm fortunate to call it home now again with my family. And my office has been here since the late 90s. So we are sitting here in an office park in the Monterey Peninsula that is just generally known as kind of the largest office park. And yes, Paul, as you indicated, it's a very fortunate scenario when you have a deal that fits the profiles that we target actually occur right here in our backyard. And this one, it couldn't be closer. It's about a quarter mile, about a block and a half away from my home office, this 160,000 square foot office park, which consists of 6 office buildings. So we had heard through the grapevine that this thing was sitting on the market, It was an offering that was unpriced, and the brokers were doing that, trying to attract the, to read through the lines, they knew the thing had a little hair on it. They knew that they were suffering from some issues relating to vacancy, and they didn't want to overshoot the mark as far as their projections of value, and they also didn't want to undershoot the mark, of course. So they put it out unpriced, which basically is an invitation for the market, for the buyer pool in general to come and start submitting bids and offers and allow the sellers to counter and start developing a negotiation and try to meet in the middle, find a common ground. Long story short, this thing has sat on the market for quite some time, and so we got a call from a local broker that we work with who is co-brokering it with the listing agents that are out of the San Francisco Bay Area. And they basically gave us some, you can't call it insider information, but they simply gave us a lay of the land. Seller's getting a little fatigued. They want to get rid of it. Timing is probably right for you to come in with an offer. They've had multiple offers. They've countered at X. We think that the deal can be done around Y. We encourage you to bring an offer. And after developing that dialogue with those agents, we've kind of honed in on our offering price, and we came in at a price. You see some of these fundamentals. Let me back up before I tell you what we're offering on it. The deficiency of this building is that it's only 62% occupied. That means there's a pretty serious vacancy rate, 38%. So in keeping with the training that you just received, we take a look at what the existing occupancy is, or the existing vacancy rate, to put it inversely, and then we compare it to the market vacancy rate. In this particular case, Monterey Peninsula, our region, is currently experiencing a vacancy rate hovering around 10%. So if you see that this thing is at 38% vacancy, what do we see? We see opportunity. Now, of course, we have to figure out why. Are there issues with the building itself? Are there obsolete components of the building that are not attracting potential tenants? Is the rent too high? Is it overpriced? Is it scaring tenants away? Or are there other extenuating circumstances? Oftentimes when you see a property that's sitting here and maybe on the surface looks like it's a great value, because again, the whisper price on this thing caught my attention. It was low relative to the value of the building that we're buying. Oftentimes you think to yourself, okay, well, we need to factor in a pretty heavy budget for capital improvements because there's probably something wrong with this thing. So at the time that we gave our last seminar, it was 3-4 weeks ago, and I had just toured the building for the first time, and I was so excited that we made it the subject of, we kind of teased it out there in our last webinar. But I was so excited about it, it might have been a little premature at the time, but the thing that really jazzed me up about it is that this building is in excellent condition. It's truly a Class A property. It does not require a huge budget for capital improvements. It's a good-looking office space. So all of the things that you feared were broken with this thing, many of those things don't even exist at all. And so the key opportunity here is you have a seller who wants to offload this thing. They're tired of managing it for one reason or another. They probably bought it, I know that they bought it, way too high. They know they're losing money. They want to cut their losses, and they want to get out. That's our opportunity. We're buying it.
Chris, I'm going to pause you, and I want everyone to pay attention now, because now let's put yourself in the shoes of Chris. This deal comes across your desk. We just spent an hour on what are the key questions we want to determine to find opportunity, and I want to see some questions right now on what you want to know or what you see as an opportunity, but what are the right questions you should be asking based on, like, this is I would imagine, because it happens to me, but I would imagine Chris gets it 2-3-fold. This is about as much information as someone will call you up or shoot you an email. Hey, got a deal. Here's some info. So let's ask smart questions. So practice, no wrong answers here. So good. Laura says, what is the current market rent? Very good question, because that would tell us the rent arbitrage. What is rent being charged? So I like that question, because we're trying to find an opportunity in the rent. What is the market rent compared to the actual? Perfect. Perfect. I see a couple of people pointing that out. Potential rent. What is the local cap rate? What do these office buildings trade for? Now, that could be possibly, obviously, cap rate analysis, could be square foot analysis, right? So that'd be a good question. And Chris will rattle off some of these deal points. Let's see. What is the market vacancy rate? Good. And as Chris shared, the market vacancy rate is what? Who remembers what he just said? In Monterey, Carmel Peninsula, 10%, right? So we know we have an opportunity on vacancy rate. What's the current operating expenses? Look how smart these folks are, Chris. Yeah, what was the, cost expenses. Good. What about, there it is. I was going to say no one brought up basis in terms of build, but what is the current cost to build? Chris, off the top of your head, being local and a developer and a builder in the area, what would it cost someone, price per square foot, to build office Class A in this market?
$250 a square foot would be a conservative to low estimate. You could easily spend $300 a square foot to build the quality here that you see in this example.
Okay, so I'd write that down, right? Because as we go through this with Chris, we want to determine, do we like this deal? Do we want to be investors? Would we pull the trigger on it? Right? Good. Some really good questions. Okay, good. All right. Okay, keep going, Chris. I wanted them to practice asking the right questions, and that for all intents and purposes, they nailed it.
Absolutely. So let's stay focused on that last question that was asked. What is the replacement cost of this property? I think a simple range would be $250 a square foot to $300 a square foot. If you're staring at the case study slide right in front of you, you can see that this building, even at 62% occupancy, is still kicking off $1,337,000 in net operating income. So I'm just going to tell you right now that the whisper number on the street that this seller was kind of effectively indicating through their broker network would be their bottom line price was $23,750,000. So who wants to do that math and tell me what the seller's asking price is, or at least their compromised asking price, on a price per square foot basis? Take out your calculators. $23,750,000 divided by 160,407 total rentable square feet.
All right, so 23,750,000 divided by our square feet of 160,000. I got a number. All right, I'm seeing some answers. Seeing some answers on the price per square foot that I like. I like the use of whisper price. It's really cute. I like that, Chris. So you guys are getting the right answer. So did Chris identify an opportunity where he can buy below basis of replacement cost? And is it a considerable amount below replacement cost? Yeah. So the answer is $148. Buying this $23,750,000, you'd be buying it for about $148 a square foot. Now, before you kind of give them the answer, Chris, put that in what does that mean? If Chris and I took this property down today at $148 a square foot, what advantage do we have over the current office marketplace in terms of leasing?
There's multiple advantages, and this is what I love about this deal. So the effective cap rate that you'd be buying it at the seller's whisper asking price, is in the mid-5 cap range, mid to high 5 cap range.
Now, I mean, for exercise purposes, how did Chris get to the cap rate? He took the NOI divided by what the seller wants, $23,750,000, and that's how we get the cap rate, right? Everybody with me on that? You know how to do all this now, whether it's a $800,000 property or $23,750,000. Perfect. Okay. All right, keep going. Sorry, bud.
Absolutely. So we're looking at a building that we can buy with in-place income. And we all know, hopefully those of you who may have been doing some commercial deals recently know that the financing rates that one can obtain from a conventional bank loan are going to be less than that cap rate. Hovering close, if we're at a 5.6, 5.7 cap rate and the interest rates that we could get on a loan are, let's say, 5.5, maybe 5, maybe as low as 4.5, if we're lucky, if we have the right lender. Obviously, what we're doing is we're buying something where you can put positive leverage on the thing by introducing debt. So we love looking at that. But, of course, that's not the reason why we're buying this thing. We're looking at the upside potential for the deal. And so that, in a nutshell, is the play here. We're looking at the ability to take this low purchase price. Paul, your original question was, what does this low purchase price do for us? It does many things. One is it allows us to look at our rent roll, figure out a rent roll that is potentially below the prevailing market rate, apply that assumption to the vacancies, and essentially go out to the marketplace and attract the potential renters that are out there floating around and attract them with a value proposition. I hate to say this because it sounds perhaps underhanded, but let's be honest, it happens every day, all day long, and it's probably a pretty darn good business model to follow. If you've got something that you can lease at a rent rate that's cheaper than the guy next door, what do? You walk across the street, you knock on that door, and you whisper to that tenant, hey, when is your lease expiring? Are you interested in relocating? I can offer you a deal. Pretty simple, straightforward pitch. You've got a nice-looking building, it's in a great location, and you're giving that tenant a deal. So we've got a very simple premise, a strategy that is not complicated, it is not capital-intensive, it is not taking a lot of time to execute, and we can go out to the marketplace and try to fill these vacancies. The beautiful thing about filling vacancies is it accomplishes two things, and I'm going to get into something that's a little more complex. It's not something I can elaborate on, but you'll get the gist of it. When you start filling space, you're accomplishing two things. Of course, you're charging your base rent. So if in this particular case, let's just say the prevailing market rents are $1.50 per square foot on a triple net basis. Triple nets mean that the tenants pay their proportionate share of the common area maintenance costs, the building's utilities costs, etc. We look at the potential to fill vacancy as accomplishing both base rent, meaning, in simple terms, we look at base rent as the income that we apply the cap rate to in order to determine the value. But there's this hidden benefit, is that the more space you get leased up, the more of the dead weight load, in other words, that 38% vacancy that exists right now is dragging down the NOI. It's dragging down the net operating income because 38% of the operating expenses are not being recovered. So the growth that you experience in your NOI is not linear. You don't go out and rent space at $1.50 a square foot, or maybe again with this value proposition, $1.40 a square foot, and realize just the value associated with that $1.40 a square foot base rent. You actually realize more value than that because you're eliminating that unrecovered operating expense load that is presently dragging down this NOI. Again, this is something that might be more easily digested if you spend hours studying an operating budget, playing with an Excel spreadsheet and understand what I'm saying, but I think you understand the gist of it, which is that you're getting income base rent, but you're also recovering this dead weight and filling that hole. And the growth then to the value of the building actually is more of a parabolic, thing. If you could graph it out, you actually grow on a better than a linear basis.
Let me. That's great. That's amazing, great stuff, Chris. Let me just kind of repeat it and see if it's sinking in. First of all, let's participate, everybody. What does triple net lease mean? Right? Capital in, capital in, capital in. The tenant pays what? The tenant pays what? Let's everybody practice answering this. I know I have my rock stars on here that know it. Everything. But what specifically? So triple net lease for offices means the tenant is going to pay the maintenance. So anything in terms of keeping up the building, the tenant pays. Taxes, the tenant pays their share of the taxes. Insurance, the tenant pays their insurance, their portion of the insurance. So unlike a multifamily where, the tenant does not pay the taxes or insurance, right? They pay maybe their utilities and that's it, and what's in their apartment to maintain, and then you maintain everything else, pay tax, insurance. Office is different. So what Chris just illustrated is that snow removal. Ain't no snow in Monterey or Carmel, Paul, but I like it. I like how you're thinking. What the interesting value opportunity here is with an office building, with it only being 62% occupied, not only when you rent it out that next, right, we're saying we're going to rent it out, we're going to lease it up 28% more because 10% is the market vacancy. That 28% increase of rent is not just going to increase the value on the rental income, but what else? What else is going to add to the bottom line? Well, the next 28% of the tenants that come in are going to pay their share, 28% to be exact, of the taxes, insurance, and maintenance. So it's, as Chris said, an exponential opportunity to increase value on the building, right? So that's huge. It's huge.
Bottom line is this net operating income has serious potential to grow, to double, to more than double. And the strategy behind it is not complicated. Yeah, of course, it takes some sweat equity. It takes a good broker network. It takes creative marketing plans, advertising. It takes good relationships. All of that stuff, that's the execution of the plan, and that's hard work, no doubt. But we can also recognize that the complexity of the execution is really actually quite simple. You've got a simple strategy, get out there and get it done. So we love this deal. Now, people are asking questions. Let's talk about, again, what are the things that attracted me to this property on just a back of the napkin basis or back of the envelope basis? Well, we did some research, and you probably all know this from Paul's other trainings, that you can go online and you can determine what the assessed value of the property taxes on this building, and you can do your reverse end, algebra to turn into to reverse into what the seller purchased this property for back when they acquired it. And the long story short is these guys paid in the price range of $40 million, high 30s, $40 million plus or minus is what the seller's holding costs are. So obviously, right at the surface level, you just get this tickle in your stomach to see that you've got an asset that is being offered to the market at a serious discount. But again, going back to...
What was that, Chris? A tickle in your stomach?
Tickle, I get little butterflies. I get little deal butterflies.
When you get to buy a deal for $23 million versus the person who's selling to you bought it for $40 million, that's a tickle in the stomach. I like that.
Yeah. It's exciting, isn't it, Paul? You know how that works.
I love
We don't get these deals offered every day. Sure, we get good deals, but some deals really stand out. That's when you get the tickle. But what I was about to say, Paul, and going back to the earlier comments, the other aspect is that property taxes is part of that triple net roster, right? Property taxes, insurance, maintenance costs. Well, if the current tenants that are in there are paying property taxes that are based on the current assessed valuation at that high $30 million range, what happens overnight to them just by virtue of me coming in and buying it at a discount? That's right, the triple nets drop because the property taxes go down. So what does that say for me? Do I have a better possibility of retaining tenants, not just going out and finding new tenants to fill space, but retaining the old tenants? Because that's very important too. Of course, now we've got an overnight savings that is offered to the tenants that already occupy the space, and so that just speaks to me. That says, great, I have more tools now to work with to retain my tenants when their leases come up for expiration. Again, just another indicator that there's a lot of upside in this thing. A lot of, we do have the ability to retain tenants, and we do have a marketable strategy to go out and fill spaces.
Chris, tell them from last month to this month on our call. Tell them about the backstory, because there's some great questions, and people are trying to understand this. What, they bought it for $40 million? They bought it. The previous owners bought it for $40 million, and now they're willing to take $23 million. Tell them that the backstory, how you sat down with the seller and their story, and the timing and situation that culminated the factors that we're seeing here today.
Sure. So the seller we did get an opportunity to meet with the seller face-to-face, eye-to-eye. Very nice guy, very seasoned as an investor and a developer of office spaces. But what we found out in the conversation is that he partnered with a joint venture partner, one of the big fund managers. We've all heard of them. In fact, in his particular case, he partnered with one of the top 5 bond funds, and they had, this is one of the funds that has many billions of dollars.
Can we tell them?
Excuse me?
Can we tell them?
Well, no, not quite yet. But the issue is, in the downturn, in the turmoil of the 2007, 8, and 9 financial crisis, the joint venture partner that this developer sourced his capital from, they effectively went under. They sold out to a much larger fund who bought all of their assets pennies on the dollar. As we all heard, there were a lot of backdoor deals made in a very rushed fashion, and the story that I got is that Blackstone, which is actually the largest bond fund in the world, the manager of something like $200 or $300 billion. You can correct me if I'm wrong because I don't know the exact number, but they're the biggest. They bought this portfolio of real estate, and nobody knows the exact number that they paid for it. But let's all assume that they bought it at a discount number that was all folded up. And now, mind you, they're buying a multi-billion-dollar portfolio of assets from a smaller sinking ship bond fund, and you can bet that they got a very healthy discount. But that deal was done in a 30-day span. So it would be impossible, irrelevant even, for me to try to extract from this owner when I'm sitting face-to-face with him what his actual current partner's perspective is on the cost basis. But let's just agree that it's somewhere significantly less than the high let's say $38 million assessed valuation that the property currently carries. So again, what does that say? It means that you've got a seller who is actually taking a haircut, but really, the haircut was taken 7 years ago by the fund that sold out to Blackstone. So these sellers are looking at a high $23 million sales price, and they probably internally, I can't say that they're making a profit on it. I wouldn't expect that. But I bet their haircut that they're taking, their loss, is actually probably a lot more modest than the surface level inquiry that we did comparing the assessed value to the $23,750 purchase price would suggest. So that explains, why is it that the seller is willing to get rid of it at such a low price? Well, their cost basis might be quite a bit lower. So they've got some motivation. They've got an asset that they thought they were buying at a cheap price, and it's just maybe not performing as stellar as they thought they would. And then here's the other aspect. There is a key tenant that just moved out of the building. That tenant was 20,000 square feet. So that tenant, that single tenant that they just lost, and they actually lost it in the middle of marketing this building for sale, which is a horrible thing to happen for a seller. They lost that tenant, and that's what's driven the vacancy rate up to 38%. So again, good timing on our part as a buyer, bad timing on their part as a seller, but they're still committed to getting rid of it. And it's just good timing, right place, right time.
So, Chris, based on just your quick, back of the envelope analysis, all the numbers you shared, we did the basis. We have an opportunity here on this property. Income, we have the opportunity there. What rough numbers? What is your kind of execution goal to get the NOI? If you get it up 28%, what are you targeting the NOI to go from 1.3 up to what when stabilized, to 10% vacancy and kind of market rents? What is your NOI target off the top of your head, not too exacting?
$2.9 million.
Okay. So 2.9 million NOI. So everybody, let's do the math. If the execution plan here is to get the NOI up to 2.9 million, and give us the market office cap rate for that area, right now, I guess, of what they would trade for.
7.5 cap, conservatively.
Okay, so
and when I say conservatively, Paul, just 2 months ago, I sold an office building at a 6.25 cap. But mind you, we are in an environment where interest rates are rising. Everybody would agree that the market is extraordinarily healthy, and so from a conservative standpoint, we like to project a worsening in cap rates. So I underwrite to a 7.5 cap.
Okay, so you got a 2.9 million target NOI and a 7.5 cap value. So everybody, do the math. What is the potential value in the future? Now, the plan takes time to execute. You need an operator that knows what they're doing. That's Chris, local, knows the market. So take 2.9 million, right, divided by 0.075. What do you get? 38,600,000 plus or minus. So who can do the math between 38 million minus 23 million? How many millions is that? It's a lot of millions. Who likes this deal? Anybody like this deal? Anybody? Anybody? I'm going to show one more number here. 7.5, right? Show one more number here. Let's see what we got. I like it. Any questions for Chris? Number one, we can wrap up. Chris, amazing. This has been fun.